The market drops 10%. Your portfolio is red, and you're about to make the one mistake that will haunt you for decades. I'm going to tell you what it is, why your brain is screaming at you to do it, and exactly how to fight that urge. Because the difference between people who build wealth and people who stay broke, it's not intelligence, it's not luck. It's what they do in the next 72 hours. If you're new to investing and the news is stressing you out, this video's for you. Let's get into it.
The number one mistake? Selling. Specifically, panic selling to preserve capital or stop the bleeding. Sounds rational, right? Market's falling, get out before it gets worse. Except here's the brutal truth. A 2024 Dalbar study found that the average investor who sold during market drops underperformed the market by 4.2% annually over 20 years. That's not a typo. Same market, same stocks, but panic sellers turned a 10% annual gain into 5.8%. That difference? That's your retirement. That's your freedom. Gone.
But why does everyone make this mistake? It's not fear, it's biology. Your amygdala, the ancient part of your brain, sees red numbers and screams, "Danger! Save yourself!" It doesn't know the difference between a bear attack and a market correction. Loss aversion kicks in at 2.5 times the intensity of potential gains. So that 10% loss, your brain processes it like a 25% loss. You're not overreacting. You're reacting normally to an abnormal situation. And normal reactions destroy wealth.
Let's look at facts. Every single market crash in history has recovered. Every single one. The 1929 crash? Recovered. The 1987 Black Monday 22% drop in one day? Recovered. 2000 dot-com bubble? Recovered. 2008 financial crisis? Recovered. March 2020 when COVID crashed us 34%? Recovered in 5 months. According to JPMorgan's 2024 analysis, if you invested at the absolute peak before every major crash since 1980, you'd still have made money if you held on. The market doesn't care about your fear. It just keeps growing.
Here's what actually happens when you panic sell. You sell at, let's say, down 15% because you can't take it anymore. You lock in those losses, real, permanent losses. Then you sit in cash, watching, waiting for the right time to get back in. But when does that feel right? When the market's up 20%? 30%? Fidelity's 2023 research found that 73% of people who sold during crashes missed the recovery entirely. They sold low, bought high, and destroyed their wealth twice, once by selling, again by missing the bounce.
Listen to me. This is your moment. Right now, while everyone else is panicking, you have a choice. You can be like everyone else, reactive, emotional, poor, or you can be different. The wealthy don't get wealthy by doing what broke people do. They get wealthy by doing the opposite. When everyone is selling, they hold. When everyone is fearful, they see opportunity. This isn't talent, this is discipline. And discipline is a choice you make every single day, especially the hard days, especially when you're scared.
Let me show you something that'll blow your mind. JPMorgan analyzed the S&P 500 from 1993 to 2023. If you stayed fully invested, you made 9.8% annually. But if you missed just the 10 best days in those 30 years, just 10 days out of 7,500 trading days, your return dropped to 5.6%. Missed the best 20 days? 2.4%. And here's the kicker. Most of those best days happened within 2 weeks of the worst days. You sell during a crash, you miss the recovery. It's mathematical suicide.
Here's the emotional journey every beginner goes through. Day 1 of the drop. It's just a dip, no big deal. Day 3. Okay, this is getting scary. Day 7. Should I sell? Everyone's talking about a crash. Day 14. I can't take this anymore. I'm out. And that day 14, that's historically when the market bottoms and starts recovering. Vanguard's 2024 behavioral study tracked this exact pattern. The moment you can't take it anymore is precisely the moment you should do nothing. Your emotions are a reverse indicator.
So what do the wealthy actually do? 3 things. 1, they do absolutely nothing. They log out of their apps and go live their lives. 2, they keep their automatic investments running. Same amount, same schedule, regardless of what the market's doing. And 3, if they have extra cash, they buy more. Warren Buffett's famous quote, "Be fearful when others are greedy, greedy when others are fearful." That's not just clever, it's a wealth-building strategy backed by 100 years of data. The best time to invest is when it feels the worst.
If this is making sense, hit subscribe. This channel is for beginners who want calm, not hype. Look, I know this is hard. Watching your money disappear on screen is terrifying. But here's what I need you to understand. It hasn't disappeared. It's just temporarily repriced. The companies you own are still making products, still making money, still operating. The value is still there. The market is just having a tantrum. And you don't sell your entire future because of a tantrum. Let's keep going.
Let me tell you about the crash of October 1987, Black Monday. The market dropped 22% in one day. One day. People thought it was over. Depression 2.0. Guess what happened? By 1989, the market had fully recovered and hit new highs. Everyone who sold during the panic missed it. Now here's the crazy part. If you weren't actively investing in 1987, you probably didn't even know that crash happened. It's a footnote. In 20 years, this drop you're worried about, it'll be a footnote too. You won't even remember it unless you sell. Then you'll remember it forever.
Imagine 2 versions of you. Version A panics and sells today. Version B holds strong. Fast forward 20 years, Version A has a decent life, some savings, but always wonders, what if? Version B is financially free, not because they were smarter, not because they had more money, because they didn't quit on one bad day. That's it. That's the only difference. One decision. Today. Which version do you want to be? Because I'm telling you right now, future you is watching this moment. Future you is begging you, don't sell.
I get it. Your friends are panicking. Your family is asking if you should get out. Social media is screaming that the sky is falling. You feel alone. But you're not. There are millions of long-term investors doing exactly what you're doing, holding firm. Not because it's easy, because it's right. A 2024 Schwab survey found that investors who had a plan and stuck to it through volatility were 5 times more likely to reach their financial goals. You have a plan. This drop is part of it. Volatility isn't a bug, it's a feature. It's the price of admission to long-term wealth.
Here's the thing about compound growth that nobody tells you. It doesn't just compound your gains, it compounds your decisions. Every time you hold through a crash, it gets easier. Every time you don't panic sell, you build that muscle. Fast forward 30 years, you're not just richer in money, you're richer in character. You've proven to yourself that you can handle uncertainty. That's worth more than any dollar amount. Hartford Funds showed that dividend investors who stayed consistent through crashes earned 3% more annually than those who traded emotionally. Consistency beats cleverness every single time.
Let me tell you about regret. If you hold and the market keeps dropping temporarily, you might feel uncomfortable. But if you sell and the market recovers without you, you will feel devastation. The regret of selling too early is 10 times worse than the discomfort of volatility. I've talked to hundreds of investors. Not one person regrets staying invested through crashes. But I've met countless people who sold during COVID, 2008 or 2000, and still talk about it like a trauma. Don't create a regret you'll carry for 20 years. Feel the discomfort now. It passes. Regret doesn't.
All right, here's exactly what you do starting right now. 1. Delete your investing apps from your home screen. Add friction. Make it harder to check constantly. 2. Set a calendar reminder to check once per month, not once per day. 3. Write down why you're investing. Retirement, house, freedom? Put it somewhere you'll see it. When panic hits, read it. 4. Automate everything. Set up automatic investments so they happen regardless of how you feel. Remove your emotions from the equation. These 4 steps have saved millions of investors from themselves.
I need you to understand something. The market will test you. It will test your patience, your discipline, your resolve. This drop, this is your test. And every wealthy person you admire has taken this test multiple times. They didn't pass because they're special. They passed because they refused to quit. Jeff Bezos, Warren Buffett, every successful investor, they've watched their portfolios drop 30%, 40%, 50%, and they held. Not because it felt good, because they knew what was on the other side. You are capable of this. You are strong enough. Prove it.
Look, in 10 years, you'll look back on this moment one of 2 ways. Either that's when I learned to stay calm and it changed my life, or that's when I panicked and it cost me everything. The choice is yours, but choose wisely, because this isn't just about money. It's about who you become. Drop a comment right now, "I'm holding." Say it publicly, make it real, hold each other accountable. And if this helped you, share it with someone who needs to hear it, someone who's about to make the biggest mistake of their life. Be the friend who saves them. See you in the next one. Stay strong.